Welcome to P&L Basics. I'm your host, Ruth King. Let me share my screen and we will get started. So again, this is Profit and Loss Basics, and I'm going to go through the different parts of a profit and loss statement. But first, thank you for being with me today. Profit and loss statements are probably the one statement that most business owners actually look at, or at least look at the bottom line, and not necessarily all the way through the P&Ls, but they look at the bottom line, and you may be one of them. And in another video, we'll talk about the basics of balance sheets, which are actually more important than P&Ls because balance sheets tell you true profitability. But I'm getting ahead of myself, and we'll cover that in a separate video. But basically today, what we're going to do is we're going to talk about just the basics of a normal profit and loss statement. It's also called an income statement. It just depends upon which software you're using and whether they're calling them P&Ls or income statements or statement of earnings for a lot of nonprofits. So they all mean exactly the same thing. They all have the base format that is exactly the same. And all it's telling you is that if it shows a profit on the bottom line, revenues were greater than expenses. And if it shows a loss on the bottom line, expenses were greater than revenue. That's it. It does not tell you how much money you have in the bank, okay? That is a balance sheet item. Cash is a balance sheet item. So P&L just simply says you have a positive number on the bottom line. That means you had a profit that month. If you had a negative number on the bottom line, you had a loss that month. That's it. The interesting thing about P&Ls is they actually start over. So I'm sure you, like me, have had bad years or bad months or, from a financial perspective, not necessarily a personal perspective. And you're like, thank goodness, I'm so glad that month is over. Oh, thank goodness, I'm so glad that year is over. It gives you an opportunity to start again. So that's what P&Ls do. They're for a very specific period of time. So you can have a P&L for January 1 through January 31st. And then guess what? February 1, it starts over again. Or you can have it for the entire year. And on January 1, it starts over again for the next year. Most convention is that profit and loss statements are calculated every single month. You can do a daily P&L. It's not going to show you a whole lot on a daily basis because what happens is you don't have all of your overhead expenses every single day. So it's much better to just, we're doing January or we're doing February or we're doing March, March 1st to March 31st, April 1st through April 30th. And that's basically your P&L. All right. The cool part about P&Ls is it allows you to make quick changes. If you don't like what last month came out like, guess what? You have the opportunity to make this month better. You had a phenomenal month last month. What did you do so that you can have a phenomenal month again this month? So that's what a P&L actually talks about. And the format is revenue or sales, and I'll explain the difference in a minute. Subtract costs of goods sold, which are also called direct costs. That equals your gross profit. You subtract out your overhead. That gives you your net operating profit. Subtract your other income and expenses, and that gives you your net profit before taxes. All right. P&Ls are simply subtraction. And we all have these fun things called cell phones that have great calculators on our cell phones if we need them. And it's not rocket science or anything like that. We start with a number and we start subtracting all the expenses against that particular revenue number. All right. So here are the pieces that I use for small businesses, not necessarily to do your taxes or something like that, but actually operate your small business on a day-to-day basis. I'd stop at net operating profit. All right. So, if you look at it, there's other income and expenses and net profit before taxes. So what I look at is I stop at basically the net operating profit line. You can go to the net profit line if you have a lot of other income or a lot of other expenses. And I'll explain what those two things are as we get through this program. So revenue is the work you generated and billed for in an accounting period. All right. Sales is the work that you sold in an accounting period. So for example, if you are a COD type company and you collect immediately upon somebody paying for a meal or going into a retail store, your revenues and your sales are exactly the same. But if you're a company that bills, like you have commercials and they pay in 30 days, then revenue is what you billed for that period of time, not necessarily what you sold for that period of time. And here's an example. Let's assume that you're working on this really big project, and this really big project is, $500,000, and you're not going to bill it all in 1 month. It's a 5-month project. So basically you're going to bill 100,000 a month if it's, equal billing. So the sale is $500,000. The revenue is $100,000, and that's what you take against the expenses because that's what you build every month. So revenue is what you build, sales is what you sold. Okay. So for those of you who do a lot of COD work, revenue and sales are exactly the same. For those of you who bill, you may start a large project, a huge project that you can't complete in a month. Then the revenue for that month is the amount that you billed for that particular month, right? So the question that you have to ask is, how does your company generate revenue? And what products does your company produce? Now, you might think this is a really, really, really simple and somewhat stupid question. Like, I sell something. Yeah, but go a little bit deeper. Let's assume you're a car wash. So your company generates revenue by the number of cars that go through the car wash. If you're a restaurant, the restaurant generates revenues by the number of meals it serves. If you're an accounting firm or you're a service company or something along those lines, you generally generate revenue through billable hours. If you don't bill an hour, you don't have any, revenue. From a perspective of an HVAC, a plumbing, electrical company, no billable hours, you don't have service, no billable hours, you don't have any replacement or projects and that type of thing. So, take the answer to this question and really drop it down to the bottom line and say, okay, how do I really generate revenue? All right. What is the one factor, my unit of revenue, so to speak? And that's really what you have to pay attention to. You have to pay attention to, obviously, that unit of revenue is profitable, i.e., if you're losing $1 for every car that goes through the car wash, you're going to put yourself out of business pretty quick. So it's not only the unit of revenue, but it's a profitable unit of revenue. And a lot of you asked me the question, should you departmentalize? So the answer is maybe. For smaller companies, probably not. I look at it by unit of revenue. So if you have different units of revenue, like you're a manufacturing company, yes, each product group will probably have their own P&L. If you're a service company, each field person or each CPA who does a specific thing actually has a department around it. So you're going to have to, if you can't departmentalize everything, departmentalize nothing. So you need to departmentalize revenue, which is the easy part, direct cost, which is a little bit more difficult, and overhead. So if you're going to departmentalize, departmentalize. If you're not going to do it, don't do it, right? So that's my rule about departmentalization. From the standpoint of cost of goods sold, cost of goods sold is an expense incurred because you generated revenues, or for those of you who are COD, you generated sales. Okay. So think about what your costs are to produce your products and your costs are to produce your services. So for service companies, it's basically labor. For product-oriented companies, it could be labor and materials, parts, equipment, things along those lines. But you have to know what it costs and what the expenses are in cost of goods sold to make sure that you have revenue and the cost of that revenue in the same month. Okay. So here's some of my examples of cost of goods sold. Billable labor. All right. If you've got people who are working on projects and generating bills to give to customers, union dues, materials and equipment, commissions, freight, subcontractor, permits. If you're traveling to a job site out of town, or you've got a client in a different state and they have to pay airfare and things along those lines, and rental cars and hotels, etc. That's really a cost of goods sold because it should be billed to that particular customer or that particular customer's project. So what I don't consider cost of goods sold is unbillable labor. So if labor is part of it, and what I mean by unbillable labor, it looks like training and meetings and vacations and holidays, then time you paid people out of the goodness of your heart because you want to keep food on their table and a roof over their heads. And the materials that you purchase for inventory and stock are not costs of goods sold. They become costs of goods sold when you actually use them on whatever work you're doing. And a salesperson's salary, all right? And here's why. Because in the salary perspective, you're going to pay that person whether or not that person sells $1 of work or, $1 of jobs. His commissions, on the other hand, are paid when the job is sold and they're part of the cost of that particular job. So cost of goods sold is the commission piece. Salary piece is not a cost of goods sold. Now, there's no hard and fast rules about these, but some companies put all their payroll taxes as they apply to billable hours in cost of goods sold. Some put truck expenses and expenses that people have for going and doing work at specific locations. They put that in cost of goods sold also. My only question or my only suggestion to you is if you put payroll taxes in cost of goods sold, they always go in cost of goods sold. You don't put them in cost of goods sold 1 month and then put them somewhere else another month in overhead. So if you're going to do it one way and be consistent, because that's the only way you're really going to see your true cost. All right. So remember, we have revenue minus cost of goods sold, which are the expenses that you have to produce whatever projects, dollars, products, services you produce. And you subtract those two and you get gross profit. And after gross profit comes overhead. And overhead is an expense that you incur because you keep your doors open. It's your rent. It's your utility bills, things like that you have to pay whether or not you sell $1 of revenue or $1 of service or something along those lines. So I consider overhead in two pieces. I consider it in payroll-related overhead, like your compensation expenses, like your 401ks, your workers' comp, your office salaries, your office labor, vacations, meetings, training, things along those lines. And then everything else to me is non-payroll related overhead, things for your building, rent, utilities, telephone. Yeah. Then you've got marketing and advertising. You've got legal fees, accounting fees, professional fees, dues and subscriptions, and it goes on and on and on and on and on. Okay. So from a compensation perspective is all non-billable time in my book goes into compensation. All office personnel time and all owner's time that's not billable to a job. All benefits and workers' comp. So basically that's compensation expenses. Everything else I call general administrative expenses, which are your advertising, marketing, bank charges, professional fee, rent, vehicle expenses, telephone expenses, and it goes on and on and on and on. That's that long list at the bottom of your P&L. Those are your G&A expenses. Now, for those of you who occasionally have what I call other income, it's cash generated outside of operational activities. So, for example, if you get 2 cents of interest on one of your savings accounts, that's other income because it was generated by an asset. It wasn't generated by producing revenue, okay? You can also have a gain on a sale of an asset, and that's generally what happens when you sell an asset and you've fully depreciated it and you sell it for $100. Well, guess what? That $100 is taxable. Just FYI, your CPA and your accounting professionals can help you with gains on sales of asset. And yes, you do have to pay taxes on it, right? Other expenses might be cash paid outside of operational activity. So like one-time legal fees, or if you lost on the sale of an asset. So for example, on your balance sheet, I know I'm going into balance sheet for a second, but on your balance sheet, your truck is worth $1,000 and you sell it only for $500. Well, you can take the other $500 as a loss on the sale of asset. All right. So again, that is more of a CPA and an accounting issue. It doesn't happen all the time. It doesn't happen as you do your day-to-day business operations to generate revenue and profit. All right. These are other expenses that might happen. You may be negotiating to buy a business or something that you have, buy a property for a business, that type of thing. And that's legal fees that you don't normally have. So they're outside expenses also. All right. So our P&L is revenue or sales Remember, sales is what you actually sell. If you're COD, your sales equals your revenue. If you're doing large projects, the large project dollar amount is the sale. The revenue is the amount that you actually bill for in a particular month, minus your cost of goods sold, or it's also called your direct cost. Gross profit, subtract out your overhead. That gives you your net operating profit. Subtract out your other income and expenses, and that gives you your net profit before taxes. Right. So that's the P&L. Well, what do you do with it? I mean, reality is, you can just basically look at the numbers, right, and throw it in a drawer and say, okay, let's see what we do next month. All right, so it's really important to do a financial review, a P&L review, and it will take you 2 minutes max to do it. So, this is from one of my clients, and his CPA was telling him, you're not making money, you're not making money, you're not making money. And he just didn't see it because all the CPA was doing was giving him this. And quite frankly, it would be really difficult for me to see that he had not really been making money, because there are months that he had a profit and months that it was lost, and it was up and down like a yo-yo. So you really couldn't tell a layperson, somebody who's a business owner like you or me, couldn't tell that he wasn't making money. So what we did was we put all of his data into the Financially Fit business software. And this is what came out. So on the left is the exact data that was on that sheet of numbers. And then on the right is what's called trailing numbers. And what we do is we take a year's worth of data a month at a time. So the blue line on top is revenue. So the revenue for June of 2023 is the revenue for July of 22, August 22, September, all the way through June of 23, add them together, divide by 12. So we've taken out all seasonality. We've taken out 5-week payrolls. We're basically looking at the trends of the company on a long-term basis. So the green line, the blue line, green line on top is revenue. The gross profit, the black line, the blue line is overhead, and the purple line is net profit. And as soon as he saw this, you see that the net profit line is zero for all intents and purposes on a long-term basis, and it's getting less than zero. And he's like, oh, and I will not use his expletive. You can imagine what his expletive was. But, we're really not making money. And it was his wake-up call. He'd been looking at numbers. He's just been looking at numbers, and he wasn't making the transition from, oh my goodness, we're really and truly not making money. Because if you look at the left, there are months that he made a profit, which is the purple line on the bottom, and there are months that he didn't. And so he's not thinking he's going in one direction or another. He's just there, so to speak. And until he put the numbers into the software, which takes less than a minute, he didn't know. And now he's actually, this is through August of 24. He's doing really, really well. The company's growing. He's doing what he needs to do to get the company profitable. But he never saw it because all the CPA was giving him was numbers. So if all you're doing is looking at numbers, you're not really doing yourself a good service about looking and truly seeing the health of your company. And I'm going to give you another example. This is another company. Then the blue line on top is total sales. The red line is gross profit. The green line is overhead. And the purple line is net operating profit. All right. You can't tell anything about the company from the graph on the left. But when we put it into the trailing data, you can tell that the company is doing really, really, really well. And how do you know the company's doing really, really, really well? Okay. So the blue line on top, the sales are growing. The gross profit is also growing. The overhead is the green line, which is basically staying fairly consistent. And the purple line, which is net operating profit. Whenever your net operating profit equals or exceeds your overhead, you have a very, very profitable company. So that's where you want to shoot for. And this will tell you a lot about what's going on with the health of your company. The one thing that you don't see from this data on the left, and you can see on the right, is that the spread between the blue total revenue line and the red gross profit line is increasing, which means that they need to raise their prices because their gross margin is actually decreasing. And you get all through this as you go through it, and you learn it. It takes It's like riding a bicycle. First time you did it, oh my gosh, you fell on your butt. How many times did I fall on my butt when I was a kid? And then you just get it so it's reflexive. And then looking at this in a little bit of time is actually reflexive for you too. All right, so here's some options for you. Number one, if you want a free financial statement review, send me an email, rking@financiallyfit.business, and I'll tell you exactly what I need. And you send it to me. I keep it confidential. I don't do anything, share it with the world, so to speak. And we'll see where you are. If you want to use the graphs and the things that I just showed you, go to www.financiallyfit.business and you can subscribe. There is a trial if you're interested in that so that you can see what it looks like and then go from there. Just let us know. Send me an email. We're happy to help. Make sure that you are continuing the financial health of your business. Okay. If you got questions, 770-729-8000 or rking@financiallyfit.business or www.financiallyfit.business. So thank you for joining me today. Have a great day.